to look at one method of calculating depreciation. This is the straight line method, right? This is where we allocate the depreciation expense equally throughout the life of the fixed asset. All right, so the formula we use is cost minus scrap value over the time. All right, time is given to us in years. So we're going to look at our first example here. A company in the mining industry has bought equipment worth 50,000 kwacha, and it has a lifespan of 5 years. Okay, it also has a residual value of 5,000, right? So this is how much the machine will be worth after 5 years. Calculate the depreciation for the equipment. All right, so we're going to use this formula. The cost, which is 50,000, minus the scrap value, which is 5,000. So we say thousand minus 5,000, and then we divide that by 5. Okay, so 50 minus 5 is 45,000. 45,000 minus 5 is 9,000, right? So this is the depreciation expense. Okay, and the journal entries for depreciation are, you're always going to debit depreciation expense. Okay, debit the depreciation expense, and you credit the accumulated depreciation, right? Always. That's the journal entry. So the expense is 9,000. So debit 9,000 to the depreciation expense, and then we'll credit accumulated depreciation 9,000. In other books, you're going to see they debit the profit or loss account, right? Basically, what it means that in the profit or loss account, the depreciation is going to be under the expenses, all right? So other books you see he has written profit or loss, but this is the general entry for depreciation. You always debit the depreciation expense and you credit the accumulated depreciation. Now let's calculate the depreciation for the equipment here. So we'll make a table here. We're going to say year, then I'm going to say depreciation. All right, and then the third column, I'm going to say the net book value. Say NBV, right? Right, so we're going to say year 0, year 1, year 2, year 3, year 4, finally year 5. All right, so for year 1, okay, year 0, we don't have any depreciation expense, so we're going to say 0 here. The net book value is going to be this 50,000, which we purchased the equipment for. So say 50,000, right? Then in year 2, all right, we have the depreciation expense of 9,000, all right? So to get our net book value, we're going to say the cost minus depreciation, all right? We're going to get 41,000. Okay. Then in year two, again, we have another depreciation expense. Because remember, in the reducing balance method, right, the depreciation will be equal every year, right? So to get the net book value for year two, we're going to say 41,000, all right, minus 9,000, that will give us 32,000. Okay. In year three, again, we're going to have another depreciation expense. Okay. The net book value for year three, we're going to say 32,000 minus 9,000, we get 23,000. All right. Then year four, depreciation expense 9,000. Right. We're going to say 23,000 minus 9,000, you get 14,000. Finally, in year five, 9,000. Right. The net book value is going to be 14,000 minus 9,000, you get 5,000. And as you can see, say that our residual value after 5 years will be 5,000, which we have here. All right. So this is how the straight line method of depreciation works.